As we head into 2023, it's becoming clear that the UK housing market is in a bit of trouble and things are heading south. So the big question is just how much are house prices going to drop in 2023 and what are my plans to deal with that scenario? So up first, I just want to show you the latest stats from the Land Registry or the ONS. And as of October, despite the fact we're in December at the moment, this data always lags a bit. So in October, the average house price in the UK was £296,000, which I think is going to pretty much be the cycle top for now. And if we go back to September, just a month before, the average price was £295,500. So pretty much sideways over those 2 months. And like I said, I think that is going to be the top. And if I bring you into another chart that I've got here, which compares the ONS, the Land Registry figures, with also things like Nationwide and Rightmove, it gives you a clear visual indication of how the ONS stats always lag what is potentially happening already or has happened already over the past couple of months. Now, before I get into this in too much more detail, I just want to shout out to these guys at builtplace.com. They released this PDF, so I kind of cherry picked the slides that I want to show you guys, but definitely check them out. They've got some really good stuff on there. So I just wanted to shout that out first because this is not my data. I just wanted to present it because I think it's important to the case that I'm going to be making in this video. So here we are. These are the house price indexes since 2019. So despite the fact this one here goes all the way back to 1970, I just want to focus on this from 2019 because a lot of people, when they're talking about house prices at the moment, they don't really think about or they don't really talk about what was happening before COVID. Now, I remember it very clearly, and I'm sure many homeowners that followed the market also remember it, is that during this period from 2018 to 2019, the market was going sideways. And there was lots of scaremonger news stories about how the housing market was going to crash. And it never actually materialized. Now, it may have materialized, but what happened was we had COVID, which changed everything. No one knew how the housing market was going to react to COVID. So we can see here from December 2018 to December 2019, things basically went sideways. Whichever indicator you're looking at, we pretty much went sideways for that year. Then, of course, we had COVID, we had lockdowns, and then everyone was expecting the market to crash, including myself. I think I made a video back then expecting the market to crash because of COVID and the fact people were probably going to be poorer. And then we just saw this huge run. And you can see house prices up since 2020 or June 2020, up 25% based on the ONS figures. So that is a crazy growth over a 2-year period. But the reason I wanted to bring this period into it from 2018 to 2019 is I think this was more of a true reflection as to where the housing market was heading. And this here is almost a false top that was created by a one-off scenario, hopefully, combined with a huge injection of liquidity and reduction in the cost of debt. So I'll come back to that in a moment, but I just want to finish off on this slide first. But if you look at this yellow line here, ONS, this is effectively copying or is representing what I was talking about here, that the market has topped off and gone sideways. So it's a zoomed in period, just showing from 2020 here. This is what we're seeing on this next PowerPoint slide here. So the ONS has topped off, I would say, over the past month or two, or in September and October, and I'm going to expect this to go into decline once it starts to catch up. Now, Nationwide and also Halifax, who aren't shown on this chart, are already reporting drops, and I think I tweeted the Halifax one a week or so ago. They reported a 2.3% drop in just a single month in November, but this graph only shows Nationwide, and then Rightmove even lower still. So for those of you that are new to the channel, the difference between these figures is Rightmove is asking prices. Anything from Nationwide or Halifax will be agreed prices based on their own data. That doesn't mean all of those agreed prices go through to complete, but it is a better indicator than just asking prices. And then the ONS are completed prices, but there's always a big lag. So the difference between your asking price and your on Rightmove and your ONS completed price is around about 5 months. That is the general conveyancing period at the moment. So what we're seeing happening in the market today, as of December 2022, will not be reported in the ONS figures until April or May 2023. So always keep that in mind when you're trying to assess these and when you hear news articles talking about house prices. Which index are they referring to and for which period of time are they referring to? So let's go down to this next slide. And this is extremely important as I could make the case that there's going to be a house price crash based on about 20 different sets of statistics. But for me, it all boils down to one thing, and that is affordability. And that's what we're going to go into in a bit more detail in this video. So firstly, let me just move me so you guys can see all of those lines. Hopefully you guys can see those now. So these are quoted mortgage rates by fixed period. So whether it's a 2-year mortgage, a 5-year mortgage, or a 10-year mortgage, and all of them are maps out here. They've also got the variable rate here. So for people that took tracker mortgages, and what they call the revert to rate, the blue line. So when you take a fixed rate, the mortgage company always quotes you the SVR that you will revert to when your fixed period comes to an end. But what we can see is pretty much since the global financial crisis in 2007, 8 and 9, the cost of debt has come down and down and down. And then what we see here, if you look closely in this bottom right hand corner, as of June 2020, which was as things very slowly started to open up after the first round of lockdowns, debt became even cheaper until it got to record lows in the middle of 2021. And as you can see, this debt getting cheaper from 2007 coincided with house prices going up. So if this debt becomes more expensive, it's a fairly logical, straightforward argument that house prices are going to come back down because people won't be able to service larger debts if the debt is more expensive. And there's something also very important in these lines I'm going to show you on the next slide as well. So we basically have gone from around about 2%, some as low as 1.5%, all the way up to about 6% within the space of a couple of months. And things have calmed down slightly over the past month or so and come down to some as low as 5% offers are available. But what's very telling, if we go to this next slide, when you look at this, the same thing again, is this is the spread between loan to value ratios. So normally if you're borrowing at 95%, you're treated as a higher risk than someone that's borrowing at a 65% loan to value ratio. So you end up getting a higher interest rate basically because they see you as a higher risk. But what's happened is this gap that used to exist between the different loan to value thresholds has basically disappeared with this hike. And what this says to me is that the lenders aren't seeing someone at 75% loan to value any safer than someone's at 95 loan to value, which to me suggests they're expecting a big drop. Otherwise, they'd be maintaining some sort of difference between these LTVs. So that's certainly an interesting thing. Obviously, that's only my own conclusion from that, but the fact these are all so close together suggests that the mortgage lenders do not see someone borrowing at 60% or 75% to be much safer than someone's at 90 or 95% loan to value. So now we know that the cost of debt has basically tripled from just under 2% to close to 6%. What does that actually mean in terms of how this will filter through to the housing market? So many people have mortgages in either a 2-year fixed or a 5-year fixed. So this chart here shows how many of these mortgages are expiring and what their initial rates were. So every quarter in the UK, we've got between 300,000 to 400,000 mortgages expiring. So potentially people that could impact the housing market if they're unable to remortgage and be able to afford that new mortgage, which is going to be at triple the interest rate of what their previous mortgage was likely to be. So in quarter 4, 2022, so what's happening at the moment, only a very small percentage of people that are going to be remortgaging had an interest rate above 2.5%, whereas a vast majority had an interest rate below 2.5%. So you've got 350,000 people with an interest rate of 2.5% or below, probably much below that, 1.5%, 2%, that are going to be remortgaging to around about 6%. And things don't really get much better as we go into 2023. So just keep that in mind as this house price correction stroke crash progresses, that every quarter you've got 300,000 to 400,000 people having to remortgage, and that's when they're really going to feel the impact of their increased mortgage costs. This is of course on top of all the other inflationary pressures, and this is also impacting buy to let mortgages as well. So people that are actually looking to make a return on their investment are seeing the cost of their mortgages on their properties go up very, very sharply, which could lead to an influx of landlords wanting to get rid of their property before they lose too much value of that property. and also before their mortgage becomes unsustainable. So that's something to keep in mind as well. And then finally, this is the house prices to earning ratios, which I'm sure you guys have seen many, many times. I can put myself back down in a reasonable position now. And we are currently above the global financial peaks. So the house prices to earnings ratio is above where we were in 2007. And in 2007, we certainly didn't have the huge inflationary issues we have at the moment with the cost of goods and the cost of energy and heating. So when you combine all of those together, I think it's going to get very, very messy. Now, just before I get to my predictions and my plan for what I'm going to be doing in 2023, if you have Twitter, you can follow me on Twitter at Darren the Degen. That is an old name from when I used to tweet about crypto stuff, so I might be changing that. If I do, I'll pin it as the top comment. But follow me on there, because I always tweet out the latest stuff that's happening in the housing market. So, how big is this crash going to be? Well, I'm going to try and make a prediction at the moment for 2023. So where do I think the ONS figures are going to be at the end of 2023? That's what I'm going to do it. So ignoring Rightmove, ignoring Halifax, ignoring Nationwide, how much of a decrease do I think that the December figures in 2023 are going to show for the year? Well, if we do the maths first, because this video is all about affordability. If your average person, we'll say the average person, let's take an example person, can afford £1,000 per month on a mortgage, and they were previously paying at 2% interest rate over a 25-year, a bank may have lent them around about £236,000. Now, of course, this will vary from lender to lender, but it's just to give you an idea of how things can change based on affordability. So let's say this person who could spend £1,000 a month could borrow up to £236,000, which on top of their deposit would probably get them to around the average UK house price of around £296,000. Now, what happens when this goes to 6%? That drops down to £155,000. So if we come in here and put in 236, which was the original one, and coming down to 155, that is a decrease of 34%, which does sound quite extreme. I certainly think that is possible. Is it likely? It's borderline. I'm not sure we'll quite get to those extremes, especially not within the period of 12 months. But if we come back to the mortgage calculator, let's say the interest rates settle around about 5% and they can borrow 171. What does that give us? 171. That gives us around about 27.5%, which I think is certainly within the realms of possibility, somewhere between 25 to 30% overall. But I don't think it's going to play out in a year. My gut feel for the year is if we're already seeing people like Halifax reporting monthly price drops of over 2%, but due to the lagging nature of the figures, we may not actually see the ONS reporting some of these drops for, well, if you imagine it's 5 months behind and the real stuff started in September after the mini budget. So September, October, November, January, February, March, we might not start to see the full drops reported by the ONS until March. So we may only get about 10 months of drops. So I think around about 15% in nominal terms is possible in 2023. Now, nominal terms is the actual price of the house. So it'd be £296,000 going down 15%. Now, I think there may be a real price decrease of around 20%. So by the time you take inflation into account, so wage growth comes into this, if wage growth is around 5% next year and house prices go down 15% from a nominal perspective, then overall you could see a drop of around 20% as the houses become slightly more affordable because your wages have gone up. So I think a nominal drop of 15% with a real world drop of 20% is my prediction for the ONS figures come December 2023. Now, I'll be interested to hear what you guys think of those. Let me know your predictions in the comments below. As for what am I doing next year because of this, well, for those of you that have been following me for a while, I actually sold my house at the very end of August. I was watching the markets, I saw what was happening, and I had the opportunity to sell my house and move into a rented accommodation for 2 years. So that is what I've done. But I'm still keeping a very close eye on the housing market. And of course, I've got that equity ready to reinvest. So what I've done over the past few weeks, I've taken the equity and I've locked it all up for 12 months in different accounts and all kind of start and end at different periods. but it's all locked up at over 4% interest rates with different providers. And the reason for that is I do not think this crash is going to play out fully in 2023. So I'm locking that money up for at least 12 months to grow that money. Now, people will make the argument that growing that money at 4%, I'm actually losing money because of inflation. But I don't see it that way because I'm not using that money for general day-to-day stuff. I'm using it for buying a house or houses when the market is sorted. So my goal for that money is to just grow it quicker than house prices. So if I can grow my equity at 4% as a minimum over the next 12 months, and house prices, hopefully for me personally, go down at least 15%, then that's a decent gain and my equity becomes much more valuable overall for me. So that's my plan for the next 12 months, is just to grow the equity, to sit on my hands and do absolutely nothing, because I don't see this market turning around until 2024 at the very earliest, and I think that could be well into 2024 as well. Of course, we don't know, there may be some sort of bailout from the government which could change things drastically, but either way, my equity is now locked up for next year, so I'm just going to sit back and watch the market and hopefully make plenty of videos keeping you guys up to date. So hopefully you guys have found this video helpful. If you did, make sure you scroll down and hit the like button. If you want to see more from me, subscribe to the channel. And if you're hoping that the housing market won't crash, I've actually produced a video covering 7 reasons why I could be wrong and the housing market may not crash. I'm going to pop that up in front of me now, and I recommend you guys give that a watch.